Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically what we are doing the foreign investments. Okay. And you can say that these are the topics we have scheduled for the discussion under the scheme like the foreign direct investments, foreign institutional investments, foreign portfolio investments. Okay. Out of these, basically we have finished with the foreign direct investments and the topics we are left with is the foreign institutional investments and the foreign portfolio investments. Okay, so basically in this lecture we are going to continue the foreign institutional investments. I hope that you have revised the previous lectures in the well enough manner before you have come for this lecture. As many times I have told you, that is for your own benefit. So if you are doing this on the regular basis, that will be beneficial for you. If you are not doing this on the regular basis, might be you face some you can say difficulties when you will giving your exam. Okay, so with this note, let's start the lecture and go forward. Okay, so here is the considerable factors, types of investments. FIIs can invest in various types of companies, including the listed, unlisted, to be listed companies on the stock markets. That is what we had discussed in the previous lecture also. Okay, and about the primary and the secondary market, that is also we had covered. So right now, basically what we are going to do, we are going to see the intention and the investment approach. Okay, intention means that what do you want? Okay, investment means what will your action? So here we are going to see the thought, action, reaction. Means first the thought will come in your mind, second the action will be done on ground. All right. So the FDIs are typically more intentional, with investors seeking to establish a long-term presence in the country and contribute to its economic development. Okay, so basically we could say that whenever we talk about any foreign enterprises like the XYZ, okay, so whenever the XYZ is coming in India through the ways of the FDI, okay, foreign direct investments. So what approach they will have? Like they could come through two means only: establish totally a new venture, and second one is acquired already established venture. Okay, established totally new venture, acquired already established venture. Okay, there are only two, you can say two ways and two means. All right, so basically if we look at these two ways, so what we are seeing, that we are seeing they both are long term. Why? Because if they invest in the new venture, okay, that will take a time. All right, it doesn't mean that in the month of January they had invested and in the month of July they had withdrawn. That is not going to happen, right? Me and you both know this. All right, even if they invest in some you can say already established venture, if they acquire it, again the things will be same, right? Suppose this is not going to happen, that the XYZ buy ABC, okay, in the month of January, all right, and sell it out in the month of July. That is not going to happen. Got it? That is the thing. So this is clear that the intention of FDI is long term. So does investment is also huge. All right, that is the intention and the investment approach. Got it? On the other hand, the FIIs, the foreign institutional investments, are often more concerned with the transfer of funds and seeking capital gains in prospective companies. Their investment decisions may be influenced by short-term market trends and the opportunities. Like you could say that when we talk about the FII, okay, so they are not acquiring ownership in any organization. Okay, it means that they are not going to acquire any ownership in any organization. Main aim is capital gains. All right, and as we know that the capital gains are typically of the two types, right? Short term gains, long term gains, right? There are only two types of capital gains. All right, so if we go by this, all right, so long term gains is only possible in the equity shares. Okay, and short term gains are for the non equity shares. Right, that is the picture. Now here comes the twist. Like we could say that it's depend upon the FII that whether they want to invest in short term gains means non equity share, in long term gains means equity shares. Okay, this is totally depend upon the FII. But here comes the twist which I was telling about, and the twist is what is the twist? That the fund is responsible for fund members' gains. The fund is basically responsible for the fund members' gain. Okay, so it means that whatever the fund members need and the requirements and gains, okay, the investment will be made as per them. If they require the short term gains, so the short term thing will be there. If they want to invest for the long time, then the long term gains will be there. All right, it's totally depend upon the fund. Whereas in FDI, the things are always for the long term. Okay, but in this approach, short term, long term, both. All right. Thereafter, investment in India via portfolio investment schemes PIS. In India, FIIs usually invest through the portfolio investment schemes after registering with the Securities and Exchange Board of India (SEBI). This scheme allows FIIs to invest in Indian securities within specific limit and the conditions. Like basically, you could say that whenever we talk about the investor and the investments, suppose you could say this is you, all right, you have 10 shares of XYZ, okay, 15 securities of ABC, okay, 10 bonds of RYZ, okay, and 13 bonds of, or you could say that 13 debentures of ZTP. This is the condition. All right. So basically, what happens here, like all of this, whatsoever is here, all of this is basically your portfolio. All right. It means that your portfolio must be registered with SEBI. Then only you will be allowed to invest into these areas. All right. And this portfolio reflects that how much holdings you have. Like 10 shares of the XYZ, 15 securities of VBC, 10 bonds of RYZ, 13 debentures of ZTP. All right. So this is there. Same things happen with the, you can say the FIIs. Like the FIIs usually invest through the portfolio schemes. Why? Because they are investing into share and security market, right? Okay. They are investing into the share and the security market. Got it? All right. It is, you can say, necessary that whenever someone wants to invest in it, they basically require to create their portfolio. All right. And the portfolio is like this, which example I have already given. Okay. This portfolio will be under the SEBI, right? Or you can say the SEBI registration is must. Okay. So if we talk about the FIIs, then what the FIIs are doing? They are investing into the share and the security market, right? So that's why they are automatically creating the portfolios like this. 10 shares of XYZ, 15 securities of ABC, 10 bonds of RYZ, 13 debentures of ZTP and all. All right. And for this, basically, they are supposed and they are required to register themselves with the SEBI. All right. And there are the specific limit and the conditions imposed on them, like as we had seen in the previous examples. Then only restricted numbers of, you can say, equity shares they could hold in any single company. Okay, this is the type of conditions we have seen in the previous lecture also, right? Thereafter, FIIs often choose to invest in developing countries because they offer greater growth potential compared to the developed economies. Emerging economies are seen as having more room for growth and expansion, which can potentially lead to the higher returns for investors. Okay, like we could say, there are two types of economies, or you can say three types of economies generally: developed, developing, and underdeveloping. Okay, in developed economies, what happened? That there is always low risk, stability, and you can say, okay, let me turn again. Low risk, stability, stagnant growth. low risk, stability, and stagnant growth. Okay. When we talk about the developing economies, high risk. Okay. Conditions are dynamic, and basically you can say there is just recorrect it. High returns, there was stagnant returns. All right. Whereas when we talk about the underdeveloping economies, there is basically you can say high risk, okay, instability, and both, or you can say volatile returns. Okay, so that is the thing. Like in developed economies, there is always low risk, stability, and the stagnant returns. In developing economies, there is high risk because they are still developing, they haven't developed. Conditions are dynamic and high returns because of the high risk. Whereas in the underdeveloped economies, the risk is high, but also there is a stability and returns are often volatile. Okay, so if we look at this, and if you're looking for some high returns and then you are looking for dynamic conditions, the most ideal case is this one, developing economies, right? That is why the FIIs, which are generally belongs to the developed economies, okay, instead of investing in their own country, they always look for the developed economies. Why? Maybe they have to face the high risk, but the conditions are dynamic and they could got the high returns. And to counter the situation, or you can say to fix the situation of the high returns, what they do, they often prefer the short-term investments. Okay, they often prefer the short-term investments. Okay, if there is a you can say much more high risk. All right. Thereafter, short-term investments and the market liquidity. Sometimes FIIs may invest in the securities for a short period of time. While this can provide liquidity in the market, it can also lead to the instability in the flow of money. Short-term investments by FIIs can result in fluctuation in the stock market prices and market volatility. For example, suppose currently the stock market value is nearly about 40,000 crores, for example. Okay. Thereafter, what happened? That the FII infused money. How much? Suppose rupees 20,000 crores. They had invested more. So right now, the valuation is nearly about 60,000 crores. How much is the valuation? 60,000 crores, right? And that is happened because of the January infusion of the FII. Now, what is there? Like if the valuation of the stock market goes up, what will happen? The prices will be fluctuate. Okay, it will show that the market is growing, and when there is a growth, always the demand will be higher and the supply is limited. So what will happen? The prices will be goes up, and that will be the condition of inflation and growth, right? Inflation and growth. Okay, but what happened, as we had discussed, that the FIIs are always having the intentions of higher growth and higher returns. Okay, so they had invested 20,000 crores in India, but suddenly the month of, you can say, April came. Okay, and you can say parallel market of India. For example, let's take an example of Indonesia. So parallelly, the market of Indonesia is started growing up. Okay. So when the Indonesian market will start growing up, what happens that the FIIs withdraw this 20,000 crores from the Indian market and invest it into the Indonesia. So what is happening here? It is a short-term investment, right? And due to this, what will happen? There will be a instability or instability occurs in the Indian market. Okay, because suddenly the huge chunk of 20,000 will be withdrawn from here. Okay, and the valuation will again back to 40,000 crores. Okay, the condition of inflation and growth will be reverse and become deflation and losses. Like you can say, those who invested money after seeing the going up valuation will now have to suffer with the losses. Okay, so here is that however they provide the liquidity in the market, but they could also lead to the instability in flow of the money. Okay, because whenever the FIIs will withdraw their amount or withdraw their money, always there will be a fluctuations. Okay, so students, basically in this lecture you could say that we have finished the foreign institution investments. Right now what we are going to start with the foreign portfolio investments. Okay, so let's start with the introduction. Foreign portfolio investments involves foreign investors investing in stocks, bonds, and other financial assets of companies in another country. Like basically, we talk about the three: foreign direct investment. Second is foreign institutional investment, and the third is foreign portfolio investment. There are the three types of, you can say, thing: FDI, FII, and FPI. Okay, so basically, if we talk about the FDI, then we know that it is done by the corporations or corporates, right? They are the one who invested into the country. Okay, whereas when we talk about the foreign institution investments, all right, these are also done by the institutions, or you can say groups. Okay, but whenever we talk about the foreign portfolio investments, these are basically individuals. All right, so that is a clear cut difference. Like the foreign direct investments is generally done by the corporations or the corporates. Foreign institutional investments is generally done by the institutions or the group. Foreign portfolio investments are generally done by the individuals, right? That is the scene. Okay, and this involves investing in the stocks, bonds, and other financial assets of the companies which are available, but not in the country's domestic stock market, but in another country. That's why these are known as the foreign portfolio investments. Got it? Unlike the FDI, foreign portfolio investors do not gain control or manage of the foreign companies they invest in. Okay, why? Because if we talk about the foreign direct investments, so there is a way like acquiring the already established venture. All right. So there is a proper way for it. But when we talk about the foreign portfolio investors, then you are just, you can say, investing in the shares, in the bonds, in the debentures, in the securities. All right. So until or unless the shares are the equity shares, you are not supposed to get the ownership, or you can say any percentage of the ownership. Whereas in the FTI, because you are directly investing in the ownership of the organization, so ultimately you will acquire the already established venture and thus you are getting the ownership directly, which is not applicable and available in the equity shares. They simply invest in the financial securities of these companies and have the right to the financial returns. Okay, like dividends, like interest, and like the capital gains. Now, what is the difference between the dividends, interest, and the capital gains? What is the difference between them? Dividends, okay, interest, capital gains. So let's talk about them one by one. Basically, when we talk about the dividends, it's a percentage of profit. Thereafter, interest, fixed return on submitted amount. Third is capital gains. It is, you can say, increased in value of asset. So let's understand them one by one. Suppose the first is the dividend. Okay. So if there are 5 members, all right, and they both had, you can say, invested rupees 2 lakhs each. So total amount will become 10 lakhs, right? Then on 10 lakh rupees, they had, you could say, generate 4 lakhs profit. All right, this is the profit. Investment is 10 lakh, profit is 4 lakh. Then this profit will be divided amongst these 5 members, right? So as per the, you can say, the contribution they had made in the investment. So if we talk about this, then we could say that they all have made equal contribution into the investment. So that's why the 4 lakhs will be divided equally, and thus it means that rupees 80,000 will be given to each member. Okay, that is known as the dividend. Like when the profit percentage is divided amongst the investor as per the contribution they had made into the final capital. Okay, like 2 lakh each, rupees 10 lakhs, profit is 4 lakhs, all the portion is same. So that's why the division will also be the same, and rupees 80,000 will be received by each and every member. Okay, whereas when we talk about the interest, so interest is the fixed proportion. Like suppose you had invested rupees 5,000 at 10% interest rate quarterly. Okay, so it means that after every 6 months you are entitled to receive rupees 50,000 in a fixed portion. Okay, that is the example of interest. Whereas when we talk about the capital gains, So the capital gains is basically stands for the increase in the value of assets. Like suppose you had purchased 100 shares at 1200. So how much amount you have provided? 1,20,000, right? That is your asset value. All right, currently. But then what happened? After some time, these 100 shares are now available at rupees 1600. And if you sold them out, then how much amount you have received? 1,60,000. So 20,000 minus 60,000. Total gain is rupees 40,000, right? That is the concept of dividend, interest, and the capital gains. So I hope that you have understand them. So basically students, in this lecture we have finished till here. In the next lecture we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture, and what we say, thank you.